How you guys doing? So I've had people ask, is it better to use a line of credit or to use excess cash that I have per month to pay off the mortgage quicker? Hey guys, it's Roderick. If you're new to this channel, welcome. On this channel, we provide an insight as to how you can achieve financial freedom with an emphasis on financial literacy. Don't forget to hit the subscribe button below and hit the bell button so you can receive notifications for when we post future content. So let's get into the subject. So many people want to know, how can they pay off their mortgage quicker? Whether using a line of credit is faster than using excess cash applied towards principal only for payments per month. So, given these two instances, the time frame of paying off a mortgage early with these two examples are pretty much even. So, the method that you would use depends on your situation individually. Let's start with the line of credit method. With the line of credit method, this may be more suited for an individual who needs a little bit more liquidity in the cash that they have, the excess cash that they have per month. This method may be preferred by someone who has already built a strong credit profile, or maybe by someone who has already built a lot of equity into their home and they're able to leverage this equity and are granted a higher line of credit. Now, having a strong credit profile may also be a reason why somebody prefers this method rather than using the excess cash method. That's because some people are able to get a zero interest line of credit. Doing this has a greater effect because now you don't have to worry about the difference between the two methods. With the line of credit having an interest rate, you can get a 0% interest rate. It's the same as using cash, except you have access to that amount. The excess cash method may be preferred by someone who's still working on a credit profile, or an individual who doesn't want to hold any more debt. Now let's talk about how these two processes work. Let's start with the line of credit, which could be a home equity line of credit or just a regular line of credit. This process works by taking your income and paying that into your line of credit. Taking your line of credit and paying for your expenses. So in order for this method to work, you need to have a positive cash flow at the end of your budget with your income minus your expenses. And that's what's going to pay down the portion of the line of credit. So this method works by taking your line of credit, applying it to your mortgage as additional principal payments, and the excess cash flow, the positive cash flow that you have in your budget each month, pays down the balance of that line of credit. When that line of credit reaches zero, you're going to rinse and repeat. You're going to take the full amount of credit that you have available on that line of credit, reapply it as a principal only payment on your mortgage. You do this until you have paid down your mortgage. It's zeroed out. Now, as far as liquidity and why people prefer this method, as you pay your income into your line of credit, you have access to that excess cash if you need it. Let's say an emergency comes up and you need that cash, you'll have access to it. Now, usually you want to have an emergency fund for those cases, but we all know life does not go perfect. So if you ever have a mishap that comes up, you'll be, more peace at mind knowing that you have this excess cash in your line of credit. Now, for those of you that don't know why either one of these methods work in paying off your mortgage quicker, let's explain that. So, the bank does not tell you about the compounding rate that's associated with your mortgage. The rate that you're quoted is your simple interest rate. So, for example, let's take a $300,000 house that you buy at, say, 4.25%. You'll probably be paying around $270,000 on top of the $300,000 that you've borrowed from the bank over the duration of your mortgage term. So about $570,000, $560,000 for a $300,000 house. And that's the money that the bank has made by loaning you money. And this is set up, with the bank really getting their money first. So a bigger portion of your monthly mortgage payment goes towards interest, and a smaller payment goes towards principal at the beginning of your mortgage term. So the bank needs their money first, and then you pay off what you've borrowed towards the end of your mortgage term. Now, what we want to do is mitigate the effects of compounding interest, which for us means that we pay less to the bank on the money that we borrowed. And a way to do this is by reducing the amount of your principal each month, because your interest is going to be compounded on the principal balance every month. So both of these methods work in trying to do that. So the line of credit method, you take a bigger portion and apply it towards additional principal payments, and then you pay that portion down on your line of credit. And then you reapply your credit to additional principal again and pay it down. You do this over and over again, as you stated before. With the excess cash method, you just take the excess cash that you have per month and you apply that towards additional principal. Now, mind you, in both of these methods, this does not include the original mortgage payment. You still have to account for that. But obviously, we're trying to pay it off quicker. So that's baseline. We already need to be making those payments monthly. Another baseline method to not include these two methods that we're speaking of today that I recommend you look into is setting up your payments for biweekly payments. Some lenders have a prepayment penalty, and some lenders do not allow you to do this. But if your lender does, I highly suggest that you look into it. This works by splitting your monthly payment into 2-week payments, which will decrease the principal amount of your mortgage little by little every month. And it will also mean that you're making one extra payment per year. This will also decrease the principal of your mortgage per year. So this is also going to work against the effects of compounding interest. Doing this, you may save anywhere from 3 to 5 years on mortgage payments. And that's not paying any additional amounts. That's just splitting your regular monthly mortgage payment into two-week payments. Now, to understand the gravity of how these methods work, let's look at the excess cash method first. So if you took an extra $500 per month and applied it towards additional principal, let's say on a $300,000 mortgage at 4.25% interest, you'll wind up paying that mortgage off rather than the 30 years in about 18 years. Now, if you had more excess cash, let's say $1,000 per month, and you applied that towards additional principal, you'd wind up paying off that 30-year mortgage in 13 years. Now, if you're fortunate enough to have more cash flow than that, let's say $2,000 would be about 8.5 years, and $5,000 will be about 4.5 years. So you can see how big of a difference that the additional principal payments make as far as how long you're under that loan. Now, to put this in terms of how this can allow you to live financially free, you could theoretically buy 3 homes in the same time it would take you to pay off 1 home in 30 years. So you could own 1 home and also own 2 investment properties, which bring in positive cash flow because those would also be paid off in 30 years or less. Now, that is, what the wealthy call passive income, and they're able to leverage their money for their time. So yes, I do suggest, everybody use either one of these 2 methods. First, use it on your primary home, your primary residence, your house where you plan on living. And then after you get that mortgage, knocked down, zeroed out, look into buying an investment property, a rental property. That way you can start to create passive income for yourself. You don't want to be stuck having to work for somebody else, your W-2 job for the rest of your life. Nobody wants to be in that situation. We want to take advantage of our time. And that's one of the benefits of being financially free. If you guys found value in this discussion, give it a like and comment below if you have any questions about these two methods. We like to create content focused on what you guys want to learn about, and we would like to help you achieve financial freedom.